I wrote an early look, was it probably 2 years ago about this, and it was focused on an old school banker. I mean, like really old school, Richard Cantillon from like 300 years ago, and he wrote about this framework, and it was fascinating back then because there were no equities. Really, the sort of only asset you could own was land. Um, and what he wrote about was this idea, because he was sort of, you know, intimately involved in basically this money printing exercise, a long, long time ago. And what he observed and what he concluded was basically that, when you print a lot of money, three things happen, and they happen in specific sequence. The first thing that happens is that you get asset prices that go straight up. And, when we printed a lot of money at the beginning of the pandemic, what happened? We got asset prices went straight up. The second thing that happens on a big lag is that you get broad-based inflation, and that's because it takes time to sort of seep out into the system. And he said it typically takes about a year. So what do we get? Well, about a year after we printed a lot of money, we started to see inflation really start to heat up. And then the third thing he said happens when you print a lot of money, and it's the last thing that happens, is you get wage inflation at the very end. But the wage inflation isn't enough to compensate for the broad-based price inflation. And so that ultimately creates this K-shaped framework where, in his day, the people who were, closest to the king in terms of, being landowners and able to benefit from the creation of money, they benefited, whereas everybody else, the further from the king you were harmed. And the modern sort of day version of this is basically the same. Asset owners, be it hard assets, financial assets, benefit from the printing of money, whereas people who are not asset owners, people who are renters, tend to be lower income folks, they get basically crushed by inflation. And the sort of modern day sort of philosophy around, what causes inflation, the best course of government action and intervention. I mean, we're going to go through it in the deck tomorrow with some slides that I think will make people's heads pop off. But, it's just, I think it's pretty straightforward, and it seems kind of like a mystery to me that it's not sort of perceived as being as straightforward as it is, but I guess that's the way things are sometimes.
The entire point here is that if Powell in any way, like they should be doing this, these guys that just wants market to go up, they're like, to your point, there's 785 economists at the Fed. Like, I wouldn't hire any of them, not one. If one of you 785 people at the Fed gave America, or the world for that matter, one of you, if you gave us 3 minutes of historical truth, like Josh Steiner just did, using a 300-year-old economist, you would change the world. You'd change their world. You'd blow their minds. You'd get fired, but you'd have a moment. Like, Steiner just had a moment. I mean, it's a pure, unadulterated, and truthful education on how money printing and or tightening monetary policy, and therefore slowing the money supply, affects the prices of things.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.